In fiscal year 2026, the Indian economy expanded by 7.6%. That level of output secured its position as the primary engine of global growth. Over that same period, headline inflation dropped to levels between 1.7 and 1.9%, while the country maintained a $700 billion safety net in foreign exchange reserves. This graph charts India's projected GDP growth for the upcoming fiscal year, revealing a jarring contradiction. Major institutions forecast an abrupt drop in growth, decelerating towards 6%. Meanwhile, inflation projections do the exact opposite, rapidly climbing past 4.6%. To find the source of this sudden squeeze, we have to look at three external and climatic shocks currently battering the Indian consumer. The first external shock stems from the conflict in West Asia, which has severely disrupted global maritime logistics and supply chains. India is particularly vulnerable to this specific regional instability. The country imports 85% of its crude oil, and those supply disruptions have pushed the Indian crude basket near $100 per barrel. Concurrently, India agreed to a trade realignment with the United States. To appease Washington and eliminate a 25% U.S. tariff on Indian exports, New Delhi committed to stop purchasing Russian oil. That agreement requires India to abandon the heavily discounted Russian crude that helped suppress domestic energy prices over the last few years. Replacing cheap Russian imports with expensive global alternatives raises the baseline cost of production. This creates a wave of cost-push inflation for domestic industries and logistics networks. India secured long-term trade access to American markets, but at the cost of a structural increase to its own manufacturing and energy expenses. Domestically, the economy is bracing for a severe climatic shock. Meteorological data forecasts a subnormal monsoon season, tracking at 92% of the historical average. Dry fields mean plummeting crop yields, and agricultural scarcity triggers surging domestic food inflation. This local inflation erodes the purchasing power of the rural workforce. That demographic alone is responsible for nearly 40% of all consumer goods spending in the country. Battling elevated food and energy prices forces the Reserve Bank of India to maintain high interest rates, a monetary policy choice that slows down overall economic growth. High borrowing costs combined with squeezed rural households place significant pressure on India's traditional, consumption-led growth model. The government is pivoting towards supply-led growth, driven by the state and heavy industry. This bar chart displays total projected capital expenditure in India. Research from Morgan Stanley reveals an $800 billion investment surge over the next 5 years, climbing to 37.5% of total GDP. This influx of capital is a direct policy response to the supply chain vulnerabilities exposed by recent global shocks. Large allocations of this capital are flowing into the defense sector to build domestic supply chains and military self-reliance. Government incentive schemes are funding a manufacturing boom, aiming to dominate electronics assembly and reduce the country's reliance on imported hardware. State-backed entities are simultaneously bankrolling a transition toward renewable energy grids. This builds a physical hedge to insulate the economy from future Middle Eastern fossil fuel shocks. The sobering FY27 GDP and inflation forecasts represent the transition between a consumption-led model and a more self-reliant industrial base. This great handoff marks the difficult shift from a vulnerable consumer economy toward an insulated industrial model.